associated with the right size or the right product. Frequently we allocate a lot of costs based on volume, based on hours run, hours produced, floor space. We've got any number of allocation systems, but anytime you're trying to allocate costs where you can't clearly identify that this cost is directly associated with this particular product, it becomes pretty subjective.
Yeah, the term cost is very slippery. It doesn't seem like it should be slippery. It seems like it should be very well-defined term with no ambiguity whatsoever. But in fact, it's used in many, many different ways by people inside business and in everyday life.
Defining costs can be particularly challenging when a large component of a company's product is creativity, which is the case with a Disney animated film.
You start with a business plan and a budget, and you have a creative idea, and in between that, there's a big gap. So we sit in that gap, and we try to look at creative issues and quantify them.
In most manufacturing operations, there are a number of costs that are difficult to tie accurately to a product. Take electricity, for example.
We use electricity everywhere in the plant. Well, how much of that should be charged to liquid peroxide? How much of it should be charged to our bleach business? And what about the power that's used in our distribution center? We have to allocate that back to the manufacturing side of the house and then split it again between a couple of products. So the more often you do those kinds of things, the less accurate your thinking becomes. I think that's probably the most difficult piece of the interview.
Significant change.
One of the most basic aspects of cost management is being able to predict the impact of changing costs. As the activity level in a company rises and falls, certain costs will rise and fall or remain the same. For planning purposes, a manager must be able to anticipate which way prices will move when conditions change, and how much prices will fluctuate.
If you don't have a concrete base of history gathered that tells you specifically why expenditures were at a certain level and why operational costs are at a certain level, historically we have no chance at all of predicting what the future is. So if you're gathering the historical operation accurately, you're documenting that, and you're understanding the impacts of that. What is the real impact of a drop in efficiency of 10%? What's the impact of a drop in efficiency of 5%? Is it half? Is it exponential? So once you understand those baselines of what's causing your problems, what's causing your expense now, then you can take that and form a model around that that gives you the best predictor of future expenditures.
To help make these determinations, costs are often categorized as variable or fixed. A variable cost increases or decreases in direct proportion to increases or decreases in a level of activity, such as units produced, units sold, hours worked, and so on. While total variable costs change, per unit costs remain the same.
Some months we have a lot of volume, next month we have very little. So labor, our glue, filter aids and supplies, maintenance, all that part of our cost system is pretty variable and moves around with our volume.
A fixed cost remains constant in total, regardless of changes in the level of activity within a relevant range. Examples include factory rent and equipment depreciation. Fixed cost per unit changes inversely with the number of units produced. More units produced from a fixed cost reduces per unit cost, and vice versa.
Our knitwear's business is more fixed cost oriented because we have a large investment in a fabric mill. It's one of the largest fabric mills of its kind in the country. So that puts a premium on us keeping that mill full because fixed costs, by their definition, are fixed and don't go away when you're not running fabric through there.
To summarize cost behavior, variable costs change in total, but are constant on a per unit basis. Fixed costs are constant in total, but vary inversely on a per unit basis. Another way companies manage resources is by assigning costs to cost objects, such as products. This process helps managers determine prices, perform profitability studies, and control spending. A cost object can be anything that managers want to track. For purposes of assigning costs to cost objects, costs are classified as either direct or indirect. Direct costs are easy and convenient to connect to an object because that object pretty clearly causes the cost to occur. Direct materials is an example, but other costs, such as designing and testing a new product, would also be direct. Indirect costs, such as utilities in a multi-product factory, are not easily or conveniently traced to a partial product.
We have those direct costs, like raw and packaging materials, our labor, but then there are certainly other costs that go along with the company: advertising expense, sales expense, logistics and transportation, which is actually our largest single cost, is getting our product to our customer.
On the direct side, clearly we have several thousand artists who are drawing artwork that end up in the film. So most of our direct costs are actually labor costs. On the indirect side, we have a variety of costs. We have a number of overhead departments that support the general production departments, such as human resources, finance, communications, things like that. So we have indirect labor there. We also then have some indirect other expense costs associated with running those departments.
For decision-making purposes, costs are further divided into differential cost, opportunity cost, and sunk cost. A difference in cost between any two alternatives is a differential cost. These costs can be fixed or variable. For example, the decision to make or buy a part requires distinguishing between costs that differ between the two alternatives. In some cases, differences in revenue will also be examined. For example, deciding whether to accept a special customer order, which may not cover certain fixed costs.
We have to, as managers, think through each decision independently and identify which costs are relevant and which costs are not relevant for that decision. And if we design accounting systems correctly, we can get categories that are going to be more useful for that purpose, but it's still not going to be automatic. Managers are still going to have to think very carefully about what costs are relevant, which costs are not relevant before making a decision.
Part of decision-making involves consideration of the opportunity cost. The opportunity cost is the potential benefit that's given up when one alternative is selected over another. For example, the contribution margin lost from cutting back production of one product to make room for the production of another. Finally, there are sunk costs. A sunk cost is a cost that has already been incurred, and it can't be changed by any decision made now or in the future. For Clorox, the sunk cost of a specialized piece of equipment used to produce a new product would not be a factor if it becomes necessary to choose whether or not to continue manufacturing the product.
So that's kind of a cost of doing business in their introduction of a new product. If the product turns out not to be successful, we clearly define what our sunk cost is, and we understand how that's impacted the organization.
However costs are classified, they are useful in understanding cost patterns, analyzing performance, and planning future operations. Ultimately, the decisions that a company must make dictates the method it uses for determining costs. A management accountant, like a good tailor, designs the cost accounting process that is best suited to the decisions made in his or her organization. Whatever the business, cost classification is based on how costs will be used, preparing external reports, planning budgets, and making decisions. When valuing inventories and determining expenses for the balance sheet and income statement, costs are classified as either product costs or period costs. Period costs are costs such as rent and administrative expenses, which are tied to a reporting period rather than a specific product. Product costs are raw materials, labor, and manufacturing overhead that can be traced to a product. To help management track and assess expenditures for planning and decision-making, costs are sorted into additional classifications. For predicting cost behavior, such as the impact of increasing output at a manufacturing plant, expenses are classified as variable or fixed. To assign costs to objects for pricing, profitability studies, and control of spending, costs are classified as direct or indirect. And to compare alternatives, costs are further classified as differential, opportunity, and sunk. In the end, calculating costs isn't a cut and dry process. Managerial accountants must tailor internal and external reports to reflect each company's unique cost issues.
That actually covers several chapters worth of determining your costs, but you're going to the direct and the indirect. That was the main thing for this particular business. So, oh, my tool ran out. What did y'all get from that? What do you think about it? What do you think about opening your eyes a little bit about to the accountant's actual job? And this is just accounting. No, this is managerial. This is managerial. This is our third level. Beyond this, believe it or not, are 2 advanced accounting classes, 2 intermediate accounting classes, 2 advanced accounting classes, and then more specific cost, specifically cost accounting, oil and gas, which is one I do, but more, even more specific into certain areas. Of course, you've got your income tax. Am I taking that one this time? Income tax. Income tax is not this. Income tax is this. Federal income tax, that's it. That's what y'all taking now? Federal? You're gonna. Next semester will be payroll. Yeah. Federal income tax. Yeah, that's a good one. That should open your eyes too to the laws that are involved in taxes. That's one of the major things they pass laws over, right? Believe it or not, daily. Well, yeah, and you'll get your stocks in accounting too. Which will be next semester. We take accounting too also, get into corporate. Some of you may have already had it and may not have covered stocks, but we're going to cover it in just a second. All right. Yeah, take it again with us. Come on. Ain't no. All right. Let's see. All right. Well, we're going to, hopefully, and as we go through here, we're going to talk about, let's see. Let me get back over here and find one. Okay. You do. If you're going to be a tax accountant. The very fact that you know when you go through this course, you learn that things have to be considered. Now, what the current ratio is or percentage or whatever, that you may not, you'll have to keep up with. But basically, you're going to know you got to look at different things. Yeah. Yeah. I know. It's true. It's true. And it's true. I know. responsibility. Auditors are like your independent firms, usually CPAs, you know, and they're public accountants, but they do auditing. But also, you can look at some of the things that happened with Enron, et cetera. That was, the auditors were in on it. They were taking the cuts. They were getting the money. And that caused people, just destroyed lots of people's lives. So, yeah. You hope they're honest. You're honest because there's professional people, you know.
Yeah, we definitely feel that all the people, you know, companies like Sparkle, it tells us like that belongs to everybody. All the retirement, everything goes, sorry.
A lot of people are suffering from that. But you know, yeah. Personally, I don't think they should have bailed out. They don't know. You can't make it in a free enterprise society, then brother, cut your costs, cut what you're doing, change your products, and get something you can make. Ford did. They take the money. No, they don't. Ford did take the money. They're fine. Ford's fine. Ford did it. Exactly. Exactly. They did not. Chrysler's owned by the government. That's wrong. Yep. Anyway, yeah. True. Okay. Prepare a statement of cost of goods manufactured. Let's look at the first section, and that's because we're going to cover the first section and look at some of these forms first and do some comparisons. Be sure that you're up on your merchandising. We know what that is. Cover like what? Like merchandising. Like Walmart, they don't actually manufacture, they just buy. Okay. And so we handle them with handling our inventories, right? We handle our inventories, bringing it in, moving it out. Okay. Manufacturing, different. And I thought it was interesting on the film, they used creativity as actually a raw material, didn't they? Creativity. Interesting. Yes, it is. But, and it has a cost. Yeah, exactly. But normally we don't think of it being that way, but it is in that kind of business. So, but usually it is goods that are manufactured have what we call more inventories. Because we've got a raw materials inventory of just stuff that's out there that we put together, right, to make a product. Okay, so we've got raw materials. Let's look at this. I don't know what page this is in the book. Yeah, we're going to look at that. It's all right, there it is. And you got your raw material. And then you've got your direct labor, which raw materials are going to be, and raw materials may be introduced anywhere in the production cycle. So, not all of it has to be put in right when it starts, right? Because you may have something you work for a while on it, blah, blah, blah. You get over here and it goes to another department and they put something else in it. So raw materials does have its own inventory. Okay, and again, on raw materials, just like on our other purchases and other inventory, we have purchases, we have discounts, and returns, allowances, discounts for our purchases. We have to come up with our raw materials and our materials purchased, take out the discount, come up with our net purchases, just like before, to come up with total materials available for use. And then we take out our ending raw materials inventories, find out the actual amount of raw materials that we used. So we get our beginning inventory plus the purchases, take out what, go get a count, what's left, to determine how much we actually use, just like on the other inventory. Direct labor, that one's not hard because it is actually the people that are on the payroll for that product, right? So they're the ones actually working on it. The manufacturing overhead includes things that we talked about in that other chapter, right? Indirect things that you allocated in the last chapter. Utilities, indirect labor, right? Repairs and maintenance, anything that had to be allocated. Supplies, depreciation, all those things that you learned how to allocate your indirect costs. To come up with your total manufacturing cost for the year and your total work in process for the year is the work that hadn't yet been completed, currently being worked on. So we stop at a point and we go, okay, how much of the product has been manufactured up to this point? This is our work that's in process that hadn't been transferred on to our finished goods to be sold yet. And so we start with our work in process for the year, less the work in process at the end, and that gives us the cost of our actual goods that we finished, right? We've got our beginning work in process, our ending work in process, right? Total work in process for the year, then we take out our ending work in process of what's left that hadn't been completed, and then what that gives us is the stuff that we have completed. Because it's no longer work in process. Right? All right. Whatever. If it's in there, yeah. If it's in there, it would be your, and they're looking at it here. So what they're looking at is everything that was put in process during this year. Whatever you started with and added to during the year, your total everything. Then at the end of the year, we just take from that number and take out what is left, just like on a regular inventory. And then when we do, we can tell what actually got sold. Went out. And we're going to get even more detailed in this later in another chapter. Okay, so components of our manufacturing costs, raw materials, direct labor, and overhead. Raw materials, no problem. Put it in, we know when. Direct labor, no problem. Manufacturing overhead, allocated. Okay, just like we did in the last chapter. Okay. Raw materials is, again, direct and indirect materials. It's stuff that's actually used in your product, the wood, the glue, the varnish, the hardware, if it's a furniture maker. It just depends on the kind of business. And indirect materials may be used to work on the materials, but aren't part of the product, but they get counted and allocated or whatever to part of the product cost. Okay. Statement of goods manufactured. Okay, so raw materials and the statement of goods manufactured. So we start with our we start at the first of the year, and we have a work in process on January 1. Whatever's in there, January 1, that wasn't completed yet, that's where we start. Right? Our work in process at the first of the year. Then as we go through the year, we add material that we throughout the year. Take out the raw materials inventory that gives you the total amount of raw materials we use. Inventory are figured the same way. Flush furnaces, flash your returns, discounts, how much is currently available left in there, when they're subtract that up what you have to see how much used. Alright. Okay. And we compute how much materials we had about. How much left? Difference is the amount used, just like regular inventory. You started with so much, purchased some more during the year. At the end of the year, you go look and see what you have left, just like supplies. Subtract it to see how much you used. Same logic. Okay? Yeah. And direct labor costs, we got that one, don't we? That's the people that actually work on the product. And, you know, that's the salaries of the workers who assemble or do the cutting, whatever. If they are actually participating in making that product, then they are direct. Indirect would be the things that are not directly involved, and these are the things that basically we have to probably allocate like we did based on some factor that we choose to use. And the overhead includes all the rest of the costs besides direct or indirect labor. Anything that's not direct labor and direct materials is considered overhead. It'll be all your other costs that you may have to allocate based on a predetermined formula. Okay. And what is it? Indirect labor, personnel, y'all did this, utilities, right? Nutrition, maintenance, taxes, insurance. Okay, this is not really new. Okay, so we know how to allocate our costs.
Products in production, process, but not yet completed. That's our work in process. Another inventory that we keep up with.
And it's accounted for in the cost of goods manufactured section of the income statement. So our income statement is going to include the cost of goods manufactured. It's going to include work in process in that income statement. So let's look at it. And the income statement is the bottom of page 905. Okay, so on the statement of cost of goods manufactured, income statement, not the income statement. No! This is still the cost of goods manufactured. Oh well, maybe this is cost of goods raw material over that applies to the work. Okay, oh well, okay, yeah. Look at number 6. I know why they put that on here. Number 6. And that is an estimate is made of the cost of the raw materials, direct labor, and manufacturing overhead that's been put into the work that is still in process. Okay. So sometimes we have to estimate that, but we have to come up with our ending work in process. How much money do we have in it? As of the end of this year, but it's not yet complete. So we do have to come up with that number. And then from there, we go to our income statement. Okay. So we take our revenue. That's so good. We know how to do that. Sales, current amount, net sales, cost of goods sold. And in our cost of goods sold, okay, we're only selling products that are finished, right? So we're looking at the finished goods inventory when we're figuring our cost of goods sold. So we're going to goods manufactured comes from, look back on your other page, it comes from your statement of the cost of goods manufactured. So there's a statement done prior to the income statement. When you're doing manufacturing, you've got to do that one first, which gives you the number you need to go on your income statement. So we've got one more statement that we have to do first. It's not an official statement, but it's a statement that we must do in order to have the numbers we need. All right. Stay with me? Okay. And the balance sheet then, after we've done the income statement, we can look at a partial balance sheet, our balance sheet, and it's going to show, is it going to show? Yes, it's going to show all of our inventory. That's okay. It's going to show our inventory. Okay. Clip out of your balance sheet showing that we've got raw materials inventory still over there in this, right? So we have to count. We've got work in process inventory, what's still in there, and then we've got finished goods inventory. So we keep up with those on our balance sheet. We show all three inventories and what's in them on that day and time. Make sense? Instead of one, we got three. Okay. Three inventory. Okay. And we really need to keep it. This is very important in a manufacturing business, you can imagine, right? You can't run out of the parts you need to make your product. So we usually use a perpetual system. That means it's updating constantly. They probably have it now where they can scan the parts they're using as it's going through and coming out of their raw materials or whatever, so that it's keeping up with what's left over there, so that we're sure we've got what we need to continue manufacturing. Very important. Very important in making your decision makings on how much to purchase. Again, I've brought this up, I know before, but lead time, how long does it take you to get that product? All those factors have to be considered in deciding when to reorder. And annually we're going to take a physical inventory to compare it to our perpetual. You can do spot checks. You can do it throughout the year, just to be sure your inventory's not walking out the door or things happening. You always want to do periodic checks. Okay, so I think. I think we'll stop there because we still have to do. I don't want to go into the worksheet today. Okay, so what we're going to do is, so that you have some experience doing this, we're going to do. Okay. What did I get to? We're going to do. Exercise 26-1. And that one we can do. We can do 6-1. And we'll skip 2. I don't want to do adjusting interest yet, but we will do 26-1 and 3. I'm going to give you some, you need some practice zeroing in on the little parts. These are not hard, they're just, you're going to figure, you know, it's going to be like figuring. And some of it's just questions. So we're going to do all of those down to, so we're going to do 1, 3, 4, 5, 6 exercises. Okay? One, 3, 4, 5, and 6, and then we'll go ahead and do. Those are just little calculations and answering a question. Which statement does this belong on? Answer. Okay. So we'll do one problem, which is 26-1A, which you will have the solution to check your work on. Okay. So do number 3, 26-3. Scratch one off your list because